Good morning, everyone. Great to see so many of you here. I'm Russel Pillemer. I'm the CEO of Pengana Capital. We really appreciate your attendance here today. We love getting to know our shareholders and investors, and we look forward to meeting you afterwards. Please hang around and have a refreshment with us. So, it was a bright sunny day during the First World War when a pilot was flying over Western Europe. Unfortunately, his plane was shot down. Fortunately, he had a parachute. Unfortunately, the parachute did not open. Fortunately, there was a haystack beneath him. Unfortunately, there was a pitchfork in the haystack. Fortunately, he missed the pitchfork. Unfortunately, he missed the haystack. Now, for all of us who are invested in international equities or in the stock market in general, we probably have a lot of empathy for our poor pilots. You know, one day we're traveling along, our portfolios are doing fantastically, the market is wonderful, it's bright and sunny. And then, bang, markets take a bit of a tumble. People are talking about this being the end of the bull market. And really, from then onwards, we wake up every day and we don't know, are the markets going to be up? Are the markets going to be down? Is it the end of the world, or is everything bright and sunny again? And this volatility, it sets into the markets from time to time. It's done so quite recently, over the last couple of months. But it is always around at various points in time. Now, it's at times like this when our shareholders and investors are really happy that they've got their money with Pengana Capital. This is the time when you want to be invested with Pengana. At Pengana, we have two aims. Our first aim is to generate good returns for our clients. You give us money because you want to make money, and we understand that, and that's what we aim to do. But at the same time, just as importantly, we need to focus on preserving your capital. We understand that you've worked hard for your money, and we need to take care of it. We need to make sure that we don't lose any significant amounts of your money. And indeed, the secret to generating good long-term returns is to consistently protect capital and generate good returns. And over time, with the magical power of compounding, that will result in great returns for our investors. So what I'd like to do today is touch on Pengana Capital, talk about who we are. I think a lot of you will know us, but give you a refresh on that. Talk about what makes us tick. How are we able to do what we do? And then finally, talk about PIAA, the old HHV, or Pengana International Equities Limited. And then after that, I'll pass over to my colleague Stephen Glass, who's one of the portfolio managers for all our international equity strategies. I'd also like to point out in the audience our new chairman, Frank Gooch. Frank's over there. And Frank was recently appointed chairman, and it's wonderful to have him as our chairman. And we look forward to him being in that position for many years to come. So who is Pengana Capital? Pengana Capital is a funds management business. We manage about $3.5 billion across several different strategies, some of them in the international space, some of them in the local Australian space. We're a publicly listed company. We became listed last year with the reverse takeover of Hunter Hall. And what we do at Pengana is we focus on high-end retail investors. It's people like yourselves. We do not focus on institutional money or big superannuation funds. And I'll talk a little bit later about why that's so important for us and indeed for you as investors. What we're most proud about is our long-term track records across multiple funds. And I think we are quite unique in the Australian context in that we have these great track records across a whole range of our funds. And that's really something in our DNA that's allowed us to do that, and I'll talk about that on some of the following slides. Finally, our focus is on delivering superior long-term returns to our clients. Now, If you probably go to any fund manager's presentations, they'll say that their focus is on generating good or superior or magnificent long-term returns for their clients. This is what everybody says. But this means different things to different people. So I just want to take a bit of time and explain what it means for us at Pengana. So the first thing is we want to generate good returns with lower risk. So at Pengana, we are not trying to be the best fund manager over any short-term period. So the newspapers are very guilty of this in that they keep on focusing everybody's attention on short-term performance. The 1-month return, the 3-month return, the 6-month return, the 12-month return. And somehow there's a lot of emphasis put on who's the top manager in those short-term periods. At Pengana, we do not necessarily want to be the top manager in any short-term period. That's not what we're about. We're about generating good, consistent, long-term returns year in and year out and compounding your money to make you great returns over the longer term. We also invest with lower risk. So as I mentioned before, we focused on capital preservation. We do not like the idea of our investors losing any meaningful amounts of money. So we're always looking at the downside. Secondly, we need to add value to our clients' portfolios. So there's no use in us doing what all other fund managers do for you. We need to be different. We need to provide diversification to your portfolios. And in particular, we're that manager who you really want to have when the markets are going maybe sideways or downwards. That's when we really come to the fore. Thirdly, what we do for our investors needs to be sustainable and repeatable. So I stood up here early on and I told you how proud I was about our historical track record. Well, that's probably not all that relevant to you as investors. You're not worried about what we did in the past. You're worried about what we're going to do for you in the future. And we've set up our business so we have maximized the potential for us to generate returns into the future, and I'll explain that next. And finally, we need to be true to label. So true to label means that when we tell you we do something for you, indeed we need to do it. So I've stood up here and I told you in our international equity space, we'll be investing in international shares, and we do this in a lower risk type of fashion. That's what we need to do for you, and therefore, you know how to use us in your portfolios. So, how do we generate these long-term returns? What is it in our DNA that has enabled us to do this time and time again? So the first thing is that we need to attract and retain the best funds management talent. As I mentioned earlier, we run several different funds, each run by distinct teams. Those teams need to be exceptional teams. At Pengana, we believe that funds management is best done at a team level. Just because somebody joins Pengana, which has got a brand and has got lots of money that we manage, doesn't mean that automatically they'll be a great fund manager. We need to go out and we need to search for the best people to run our funds. And we've probably spent more time and effort over the years in finding these exceptional people than we have in doing anything else. Secondly, funds management is a complicated business these days. You need to have systems, you need to have processes, procedures, compliance, etc., etc. At Pengana, we have a very strong institutional infrastructure. So we are not one of those businesses that you might have seen, which people talk about as being a boutique business, where there's one dominant person who runs the funds as well as running the company. We don't do that. In Pengana, our funds management team manages the portfolios, they pick the stocks, but at an institutional level, we have a very strong infrastructure. And indeed, we oversight our funds, we do the compliance, we have separation of duties. So you can always have that confidence when you invested with a Pengana fund that somebody's looking over the fund for you. Thirdly, culture. Now, talk about culture, I've put it up there as number 3 on the page, but probably should be number 1. And the reason for this is because it's related to the people that we want to attract and retain. You can only attract the best people to manage your funds if you've got a great culture. And so we need a whole infrastructure with everybody around them who embrace our culture and make our workplace a really happy and exciting place to come to work. You don't hear many fund managers talk about culture. In fact, very few of them do so. But for us, culture is extremely important. Fourthly, capacity constraints and fees. So this is probably the most important message that I can give you about funds management. And that is, in most industries, bigger is better. So if you need a new cell phone, you'll probably go and buy an Apple because they're the biggest and best company. They got the most stores out there. And that's probably a logical thing to do. In funds management, it does not work like that. If you are too big in funds management, it is to the detriment of your investors. It might be very good for the fund manager, but it is to the detriment of investors. And the reason for this is that if you have too much money to manage, then every time you buy stocks, you need to buy a lot of them. And guess what? You push the price up. You pay more than everybody else does. Similarly, if you want to sell your positions, you need to sell a lot of stock. And guess what? You push the prices down. You get less proceeds for it. So if you're a fund manager who has too much money, you're basically operating from a position of severe disadvantage. At Pengana, we're very conscious of this, and we cap our funds at certain levels where we maximize value for our investors. So we never go above a level where it will impact the prices that we need to pay to buy stocks, or indeed the prices that we get when we sell stocks. The flip side of this is that we need to charge full fees. We don't discount our product. We cap our funds at lower levels, and our investors are very happy with this trade-off, paying full fees and in exchange for that, getting good performance. Next, I mentioned that all of our clients are investors such as yourself, private individuals. We don't like taking money from big superannuation funds because what they like to do is to give you tons of money, pay you small fees, and guess what? They suck up all your capacity, and it's bad for the other investors. They can also pull out hundreds of millions of dollars in one foul swoop, and what does that do for the rest of the investors in the fund? It's really, it can be horrible for them. So we don't seek large institutional clients, and indeed we turn them away most of the time, or virtually all of the time. And finally, we're something called benchmark unaware. So you might have seen this term being used in the press. What is benchmark unaware? Benchmark basically means the stock market or the stock index. So if you invested in Australia, the benchmark would be the ASX. If you invested in international equities, it's something called the MSCI index. So bizarrely enough, most fund managers in the marketplace are focused on beating the index. So if the market goes up 10% and they go up 9%, they think they've done a bad job. Likewise, if the market goes down 10% and they go down 9%, they think they're heroes and they've done a fantastic job. It's a bizarre world in which we live. I'm sure you will all agree. At Pengana, we do not care about the index. We are not focused on beating the index. Yes, over time we expect to, and certainly aim to generate better returns than from the market. But what we're focused on is generating good returns for our clients, irrespective of the index. So this page up here sets out the various strategies that we run at Pengana. As you can see, we have international equities, Australian equities, and some absolute return or hedge fund strategies. So in the international space, you can see the all caps, and by all caps we mean companies with all different sizes of capitalization. So small companies, medium-sized companies, large companies. So our international equities team, that Stephen will talk about in our funds, that's that light green section. All those, you can see we've got a range of different funds that we operate, but essentially the underlying shares in each of those funds is almost identical. We also then have global small caps, so this invests in much smaller companies. The average size of those companies is about $1 billion, which in a global context is very small. And then we also have an impact investing or sustainable investing fund that invests in companies that do positive things for the environment and for the world. On the Australian equity side, we have Australian all caps, and we also have Australian small caps. And then on the hedge fund or absolute return side, we have a global absolute return strategy and an Asia-Pacific absolute return strategy. And what both of those strategies try to do is generate returns irrespective of whether equity markets are going up or down. So that's our range of strategies. We suggest to our private investors that the best way you can use Pengana is to spread yourself across our strategies. All of the strategies are very high quality strategies. They work well together. They're each run by different teams. So they give you diversification. They're not correlated with each other. And I'd encourage you to take a look at all of our strategies and become more invested in the Pengana group of funds. So finally, talking about PIAA, Pengana International Equities Limited. We changed the name a few months ago. I think everybody would be aware. So currently, well, it actually says here the net asset value is pre-tax $1.23 and post-tax, pre-tax $1.25 and post-tax $1.23. The difference between those two is if we were to sell off all our positions where we've made gains on a net basis, then we'd actually have to pay tax of 2 cents in the vehicle. So that's the difference between pre-tax and post-tax. The share price ranges are really from time to time based upon how many buyers and sellers there are in the market, based upon supply and demand. We would ultimately like to get it up to its NTA level, but as I say, from time to time it trades differently. I think the range at which it's traded over the last few months has been anywhere from $1.16 to $1.21. At the moment, I think as of the close yesterday, it was $1.18. Last year, we announced an option issue. We issued one option for every share that every investor held. Those options are currently trading a little bit below 2 cents a share. I think it was 1.7 cents as of the close yesterday. The options are capable of being exercised any time prior to 10th of May 2019. So there's something called American options, which means you can exercise them any day you want. You don't have to wait right till the end. And so that's good in terms of flexibility and value of the options. We recently announced an interim dividend of 3.5 cents a share, which we're very happy to announce and pay to our shareholders. We understand that our shareholders very much value their dividends. It is 100% fully franked, and it will be paid on the 30th of April this year. If you acquire shares prior to the record date, and the record date is the 13th of April, if you acquire shares prior to that date, you will receive the fully franked dividend and the imputation credits that come with it, which might be very valuable to investors. Maybe not so valuable under a change of government, but certainly very valuable at the moment. So whether investors buy new shares or whether they exercise their options and acquire shares that way, either way, provided you do that prior to the 13th of April, you will be able to get the franking credits, the dividend with the attached franking credits. So I'm going to leave off there. We'll have plenty of time for questions afterwards, and I'm going to pass over to my colleague, Stephen Glass.
Good morning, everybody. I'd like to start by congratulating all of you for putting in the efforts to be here today. We will be discussing how we manage your money, which is a critical issue for me and for you. So you've done yourself credit by joining us today. My name is Stephen Glass, and I'm portfolio manager and co-founder of the Pengana International Equities family of funds, some of which are on the screen before you. It has almost been a year since Pengana acquired Hunter Hall, and my team took over management of the Hunter Hall International Funds. And in that time, we've made some slight adjustments to the Hunter Hall funds, the most recent being a name change. The Hunter Hall Value Growth Trust is now known as Pengana International Fund Ethical. This name more clearly communicates that the fund invests internationally and ethically, which we know are key considerations for investors in that fund. Looking at the screen, you might think that our team offers multiple different strategies, but in fact, all these funds have the identical strategy and indistinguishable portfolios. It is a mere quirk of history and tax law that there are a number of different funds before you. But for all intents and purposes, they are exactly the same. So if you like what you hear today, you can feel free to invest in any one of our funds. And if you want to discuss quirks of history or tax law, I highly recommend you corner Russel Pillemer. He is a former Goldman Sachs investment banker. He loves talking about fund structures and tax law. There is nothing he would rather do, so you'll make his day if you do it. But there's also a chance for you to make my day today. I rarely enjoy meeting our co-investors and hearing your comments and questions, and I hope that today is no different. There will be time for this at the conclusion of my official talk, and if you don't get the chance today or something pops into your head a bit later, please, Pengana's client services team, led by Dan Fine over here, and his team with Georgia and with Jared, are first class, and they will be very responsive, so you can always contact them, and I'm also available to discuss any of your pressing issues. We've just been going around Australia, and I was just in Brisbane, I was in Canberra, I was in Gold Coast, and something that really struck me is that these cities, whenever I go to them, I go in 6-month blocks, and they are always very familiar to me, but yet they're always dynamic. There are always changes. There's always something developing in that city. And I think that is a really good introduction for the key topic of today's discussion, which is some things never change, but some things can't stay the same. This slide is one of those things that never changes. It calls out the key attributes of our strategy. There's a lot happening there, so I'm going to call out the 3 that I think are really important. 1, we invest internationally. We actively seek appropriate investments across the whole world, in both emerging markets and developed markets. This is important, because needlessly narrowing the geographic scope of your investment universe means you will miss out on fantastic investment opportunities. In addition to our current investments in the US and Europe, we currently have investments in India, China, Israel, Mexico, and we have held investments in Brazil. So we are truly an international fund. The second point I'd like to call out is we are going to cap the fund at $7 billion. And we have been investing as if it's a $7 billion fund since inception. This is important for 2 reasons. Firstly, the fact we've been managing it as a $7 billion fund since inception. Since we started with $1 million under management, we manage it as though it was $7 billion, shows that all our returns are repeatable. We haven't taken quick, easy wins going in little IPOs and little speculative stocks that may double or triple. No, we're doing things the right way from inception. So you can have confidence that everything you hear today will be repeated as we grow. The other reason it's important, and the main reason it's important, is because when a fund gets too big, it can no longer invest in small caps, and so it's going to narrow its investment universe. So by capping our fund at $7 billion, we are still able to invest in companies as small as $1.5 billion, which is really a small cap by international standards. We currently have an investment in a Portuguese company called Corteira Amarin, which has a $2 billion market cap, and we also hold shares in Google, the $800 billion behemoth. The final point I'm going to call out today, which I think is the critical point, is we are an evergreen fund. That's just another way of saying we are a core fund. Our funds have been specifically designed to be the epicenter of your international equities exposure. It is the type of fund you can put a lot of money in and you can hold for the long term through the good times and the difficult times. You might ask yourself, how can I make that kind of claim? Or what constitutes a core fund? Most good fund managers, and I emphasize the word good because not every fund manager, most good fund managers have the solitary goal of trying to deliver as large as possible returns as they can. This is an admirable goal, but it is insufficient for a core fund, and we have 3 goals. 1, to make money. 2, to minimize losses. And 3, to minimize volatility. These are not easy goals to deliver on, but we have done it since inception. And the reason we have done it can be broken up into 2 parts. We have a portfolio construction system that never changes. Last time I was here, 6 months ago, when I discussed how we invest, you're going to hear the exact same message today. 6 months' time from now, you're going to hear it again. 6 years from now, again. 6 decades from now, again. Whether it's me talking or one of my colleagues talking, this is going to be the same message. This is how we invest. However, within that framework, we take action. The world is a dynamic place, and that has never been more true than right now. Politics moves in strange directions. Technology is altering entire industries. Capital flows across markets at the push of a button. This is not the time where a fund manager can just stand still. As my wife often tells me, even a hard-boiled egg has a heart of gold, which basically means it's not good enough to have good intentions. You have to take action. And that is why I do the dishes every night. So now I'm going to discuss how our portfolio construction system that never changes. It can be broken up into two parts. One, the way we pick stocks, and two, the way we put stocks together. This is a slide that would be familiar to prior attendees of our presentations. It calls out the criteria we look for when we pick in stocks. It's called the 6 pillars of successful stock selection. Now, I could spend hours on this slide because it's highly nuanced. It was developed over a long period of time, and it can be very technical. But the crux of the message is we're seeking highly cash flow generative companies at a reasonable valuation that are well positioned to grow and are unlikely to blow up. Good things happen when you buy good companies at a good price. This is simple, it's logical, it's common sense, and it works. This is a slide that would definitely be familiar to prior attendees, and I would say it's probably the most important slide we will show today. And I joke with people, I say it's the most important slide you'll ever see. But we will definitely show this again because it is so important, and it's our unique methodology for putting together portfolios. And I know it's unique because it was designed by us. More specifically, by our CIO, Jordan Svetanovsky, designed it whilst he was working in Europe, and definitely a man you should meet and discuss. I've presented twice to you. Next time, hopefully, you'll get to hear from Jordan. But what it basically does is we divide all companies and our portfolio into 3 segments: core, cyclical, and opportunistic. Core are those dominant companies that generate stable earnings and are trading at a reasonable valuation. They form the base of our portfolio and can take you through all different kinds of market environments. The trick to investing in these companies is to identify sustainable competitive advantages and ensure you don't overpay. We target 60 to 80% of the portfolio to be invested in core stocks. Cyclical are cyclical stocks with more variable earnings. You can make a lot of money from these stocks, but you can also lose a lot. So that's why you have to have special risk control metrics around them to help avoid those big losses. 0 to 30% of the fund is always invested in cyclical. 0 when we can't find anything, up to 30 when we can find a lot. Now, if we were the world's best cyclical investors, you'll have 100% of your funds in cyclical stocks because you really can make a lot of money from them. But they are risky, and that's why we cap it at 30%. Opportunistic is a third bucket. 0 to 20% of the fund is invested in opportunistic stocks. These are unique company-specific opportunities. They might be rapidly growing companies that are too expensive to be considered core, or they might be companies going through a temporary turnaround that are insufficient quality to currently be considered core. The point is there are great opportunities, we can't ignore them, and so we go out there to find all of them. And we're able to do this because of our portfolio construction system. It creates a framework for risk-controlled investments across all investment opportunities. But the real benefit of it is it results in a portfolio of the 30 to 50 stocks that work best together, rather than just the 30 to 50 best stocks. Think of it as an orchestra. You don't need just the best tubists everywhere. You need different people that play different instruments. You need I won't say I'm an aficionado of musicians, but I would say I do know that you need different types of instruments in a band. So that's a key point. We have a portfolio that brings everything together so it's harmonized and creates beautiful music. This chart illustrates what you can expect from core style investments. As you can see, they generate nice, stable and growing cash flows over time. All companies have a degree of cyclicality, so we invest across multiple different core opportunities. And these different opportunities net each other off for a more smooth ride up. On this chart are some examples of our current core positions, and I'll be more than happy to discuss any of them with you later if we have time. This chart illustrates what to expect from cyclical opportunities. As you can see, the cash flows are highly cyclical. The trick is to buy here and sell here. I would just call out that we currently have quite a large investment in European banks, which we consider quite cyclical. So that's our biggest, probably our largest cyclical investment at the moment, and we're very lucky to have Ryan Fisher today, who's our financials analyst, and if anyone has questions a bit later, he would be more than happy to answer them. The third bucket are opportunistic, and here we've got some examples of what might constitute opportunistic. We've got these fast-growing companies that are too expensive to be core, or these companies where they've got a current issue they're trying to resolve, and then they might become core. On the chart are some examples of our current opportunistic investments, and if I get a chance a bit later, I would love to discuss some of them, in particular flow traders. We'll see how we go with time. So when you bring it all together, the key message I want to leave you with about our portfolio construction system is that it's highly disciplined and we stick to it. It's got metrics that we understand and we can follow. It results in high quality stocks, good stocks at a good price. And most importantly, it results in a portfolio of the 30 to 50 stocks that work best together. Nothing has changed since last time we spoke, and nothing will change the next time we speak. So then what has changed? Some things can't stay the same. I'm now going to demonstrate to you that we have taken action as the facts warrant. This slightly intimidating chart is not actually that complicated, and I will explain it. It basically illustrates our portfolio's industry exposure over time. Each color is a different industry, and the size of the color block represents the portfolio's total exposure to that industry at that point of time. For example, this purple area represents financials. For a large part of the fund's life, we had very little exposure to financials, but more recently, we've increased it quite a lot. I mentioned earlier, part of that reflects our view about European financials. We think we know the European economy is looking very stable, it's doing well. Lending is starting to increase in Europe. These banks have very strong balance sheets. They were forced to fix their balance sheets following the European banking crisis. And they're in reasonable valuation, so we think we're set up for a good cyclical upturn in European banks. This section up here, the lilac section, represents the fund's exposure to IT. Companies like Google, Apple, Amazon. We don't currently hold Amazon or Apple, but those kind of companies. For a large portion of the fund's life, we had about 25% of the fund invested in IT, which is the largest exposure we'll ever have to one segment. So large exposure to IT. More recently, we've curtailed it. The fund has now less than 10% of its total assets invested in the IT sector. This reflects the fact the IT sector has become expensive. Our investments there have reached their price targets. We're not finding many other ideas out there in that sector because they are so expensive. So we sold. Now, it's very easy. It might sound easy for me to just come here and just say, you know, we've sold IT, and you go, well, of course you'd sell IT. Well, why wouldn't you? It looks expensive. But let me tell you, it's a very difficult thing to do. Right now, IT is the flavor of the day. No one is going to look dumb saying, guess what, I just bought Amazon, Google, and Apple, and Netflix. In fact, you probably look pretty smart. But the fact of the matter is it's expensive, and so we've acted. Now, this sector continues to grind up on momentum, and I don't know how much longer that will go for. But I was around in the tech wreck, and I know what can happen if something goes wrong. So it's time to take some of those profits off the table, and that is exactly what we've done. So the key message I'd like to leave with you about this particular slide is twofold. One, there's lots of colors on the slide, which means there's lots of industries on the slide, which means the portfolio has been nicely diversified through time, as called for by our portfolio construction system. Two, the size of the colors have changed over time, which proves that we have taken action as we think the facts warrant. This slide illustrates the fund's exposure to different geographies over time. The green section is Europe, the blue section's the US, red is emerging markets, this orange mustard is cash, and then we've got Canada and UK. The key message I'd like to leave with you about this slide is we have had large exposure to developed markets for some time, Europe and the US. However, we have dramatically reduced our exposure to the US recently. Over here, we had probably 50% of the portfolio in the US. Today, it's probably about 35%. This reflects our view that the US has become fully valued. It is expensive. I love the US. There are terrific companies there. They're innovative. They do a lot of things right. However, everything has got a price, so we have acted. The second thing I'll highlight is our exposure to Europe. Has always been large, and it's actually increased over time. This reflects our view that we think Europe is good value at the moment. People say, well, the problem with Europe is the economy. How many people in this room know that Europe actually outgrew the US last year? Maybe not many. This year, the US is expected to grow 2.7%. Europe is expected to grow 2.5%. There's a negligible difference. Then people say, yes, but European politics are so bad. Well, actually, we think Macron is a fantastic leader in France. Italy is gridlocked, but it's always going to be gridlocked. But Renzi is actually a pretty strong leader as well. Merkel has formed a coalition in Germany, and we think she's a strong leader. Wilmers did not win in the Netherlands, so he was the far-right candidate. He didn't win, so that's also looking okay. Austria has had mixed results. First, the far-right didn't win. Now they've won some seats, but it's okay. Austria's around an area in the grand scheme of things. So we think Europe looks very attractive, and it's also a lot cheaper than the US. Europe is on about a 15 times PE. The US is on about a 19 times PE. At best, could be higher because they're buying back shares, which is boosting the valuations. So when you bring it all together, we think it's the right time to take money out of the US and put more into Europe, and so that's what we've done. The third point I'm going to pull out here is our exposure to emerging markets. You can see we've always had some, but we have actually increased it more recently. It's about 10% of the portfolio. This is direct exposure to emerging markets, and I wouldn't be surprised if it grows from here. I doubt will it ever be more than 20%, but it can be. I don't know, but at the moment we've got about 10%. The reason we've done that is the facts have changed. Yes, emerging markets have always had a great long-term outlook. We're aware of that, but there are also some shorter-term facts that have changed. For example, we think there are some headwinds for the US dollar. They have the twin fiscal deficit, which is the government deficit, and the current account deficit. Historically, these two factors are bad for a currency, so if the US dollar is weak, that is typically good for emerging markets. The other thing that's changed is we are in a period of signalized global growth, and that is typically very good for emerging markets. And finally, their valuations look good. So what we did, we've increased our exposure to emerging markets. Just last week, I returned from Mexico. We think Mexico looks quite interesting at the moment because it's become cheaper because people are worried about NAFTA and the Mexican elections a bit later this year. It does have headwinds, there are issues, but the point I'm making is we've gone there, we've done the work, we're ready to act when the opportunity arises. Jordan recently returned from the Philippines, Thailand, Hong Kong. He's done a big tour of Asia. We're doing the work. We think Thailand is currently, the consumer looks a bit highly geared for us at the moment, but we're doing the work up front. Philippines looks very interesting, but it's quite expensive. The point I'm making is we spend a lot of time on the road. We are visiting these countries. We know what's happening, and when the time arrives to invest, we're not scared to do it. This chart is a little bit confusing, but I'm going to give it a good go to explain it to you. Everything under this grey line represents the fund's exposure into the share market. So here, it's about 87%. About 87% of the fund was invested in shares. The area above this grey line is the fund's cash holdings. So here we had about 87% in shares and about 17% in cash. I don't know why we've used grey for both the cash and the shares, but that's the way it is. This orange section is the fund's holdings of portfolio insurance. You can think of portfolio insurance like home insurance. You don't buy it hoping that your house burns down. But when there's a bushfire, you're pretty happy that you've got it. The way it's different to home insurance is this portfolio insurance is very expensive. So you never buy it to protect your entire portfolio. If we did, there would be no absolute return. So you buy to protect a portion of your portfolio. For us, the most we will ever do is about 10% of the portfolio. So what it does, it takes the sting out of the tail. It won't protect entirely, but it certainly does provide some protection. Now, I've got no doubt there's going to be questions about portfolio insurance today, and I'll be delighted to answer those questions. But the real reason I've got the slide here is because I want to show how we've taken action. So that's the key point for now. Over here, we had a large exposure to, we had a lot of insurance. That was because this was the time around Brexit and the US elections with Trump. Look, we didn't know what the outcome would be. No one could know what the outcome would be, what it would do to the share market. But what we did know is there was a lot of risk there. Things could have turned very ugly very quickly. So what we did was we bought some portfolio insurance. We didn't sit there and twiddle our thumbs and think, gee, I hope it all turns out all right. No, we took action. This period over here, there's very little portfolio insurance. This is because we're more sanguine about the risk outlook at this point of time. Brexit had flown through, we could now analyze it. Trump had been elected, we could analyze his policies. Valuations were okay, we felt more comfortable about the risks out there. More recently, we have dramatically increased the portfolio insurance. This reflects our view that markets have become exuberant, valuations are looking full, interest rates are going up. It's time to get more protection. So the key point is, when we see the risks, we are going to take action and buy some extra insurance for the portfolio. So the key points of this whole discussion about active management is, yes, we do take action. We've changed industry exposure as warranted. We've changed geographic exposure as warranted. We've bought insurance when we think we need it. We are not hard-boiled eggs. We don't just have heart of gold. We actually take action. Now, it's all well and good. I've now explained this fantastic portfolio construction system, and I've explained how we take action. But how's it actually performed against our three aims of make money, avoid losses, and minimize volatility? I'm really proud to say that we've delivered on all three of our aims since inception. We have delivered a total positive return of 30% since inception. You can see we are the green line, the blue line's the market. It's been a relatively smooth ride with us. And importantly, we've saved money where it counts. Again, we're the green line, and the blue line's the market. And in February, when the market dropped a lot, we didn't drop as much. So we have delivered against our three aims. Now, not once did I say that our aim is to beat the market. But you know what? We have. And this is no mean feat. We're very proud of it because the current market environment encourages and rewards risk-taking, and we're managing the funds very conservatively. So we think this is a real achievement, and we've done it through really good stock selection. We think this relative outperformance will grow over time. So, sorry, just to demonstrate, the market's done 26% since inception. We've done 30%. And we think our relative outperformance will grow over time, particularly when some of the current euphoria inevitably drains out of the market. And here's the proof. This chart illustrates our fund's returns every single time the market has dropped more than 2% in a day. So over here, this was the flash crash of 2015. The market dropped 4.3% in a day. Our funds dropped 1.3%. After Brexit, markets dropped 4, we were down 3. Last month, market down 3, we were down less than 1. And then it was down 2.4, we were down about 1. Every single time the market drops a lot, we do better than the market, which is good, which shows we will deliver on our aims. And the reason we'll do it is really multifold. Firstly, it's the type of stocks we buy, those good quality companies at a good price. Secondly, it's the way we put the portfolio together, the portfolio segmentation strategy with diversification and having a team of stocks rather than just individual stars. Then we have the options, which actually provide, just take the sting out of the tail. Just to give you some idea of how much protection you will get, because I know there'll be questions. Last month, I would argue this difference of 3% compared to 1, I would argue that approximately 50 basis points of that protection came from the insurance, but a lot of the other protection came from the way we actually pick stocks put the portfolio together, and importantly, we even try to make money from these kind of events. And that relates to Flow Traders, which is a stock that I will speak to a bit later, and I know we'll have time because it's important. So the key message is we've delivered on our aims, we've made money, we've minimized volatility, and we've also saved money where it counts. We expect to deliver on our aims. Now, it's all well and good that we deliver on our financial objectives, but I know that for many of you, delivering on our ethical requirements are just as important. In the topic of staying consistent with the topic of today, there are some things that never change, but there are some things that can't stay the same. The things that never change are the banned activities. We still don't invest in casinos, intensive animal husbandry, weaponry, coal, tobacco, among other industries. The thing that has changed is the way we implement the ethical policy. Our understanding of the way it was done previously was Peter Hall basically had the final say, and with some help from Care Australia. Peter took this very seriously. He had sound judgment. He's a very clever man, and we think he made good decisions. But we have decided to do things a little bit differently. We have engaged a firm called Sustainalytics to help us with our ethical analysis. Sustainalytics is one of the 2 world's largest ethical analytical firms. They're based in the US. They were established 25 years ago. They've got offices all over the world. They have 170 ethical analysts, and they cover 4,200 companies. Now, I've just thrown a whole lot of numbers at you, but we should just stop and think about that. I don't know this for a fact, but I would take a bet that Macquarie Bank have fewer than 170 analysts in their entire global stockbroking business. The point I'm making about this is Sustainalytics are the real deal. They know what they're doing with ethical analysis. They get access to the company to ask the right questions. They know the right questions to ask. They are very good, and we are paying for it. Not you, we are paying for it from our own profit and loss statement. So we're basically buying 2 products from them. The first one is a database of all the banned activities. So that tells us if a company does something that is banned, so that if it is highly involved in coal or sells weapons, so on and so forth. The other product that we buy from them really is an example of us going above and beyond what's really required, and that is the controversies database. This database records all the activities a company has been involved in that are known and are unethical. If a company is involved in a lot of these controversies or severe controversies, we cannot invest in them. A good example would be Volkswagen. We are able to invest in automobile manufacturers, but that company was involved in a bad controversy. It cheated on the emissions testing, so it doesn't pass the screen. Now, we take this seriously. We think it's important. We could self-police, but we know there's a better way to do it. And that's why we have an independent adjudicator to monitor and enforce compliance. Pengana's Chief Risk Officer is responsible for monitoring our portfolio from an ethical perspective, and he is entirely separate to our team, and he has a veto vote over which stocks can go in or out. So we're following all best practice. But we even take it a step further. We will engage with our investors. We will show our portfolios from time to time, a full portfolio, so you can actually see what we've held and you can comment on it. Now, there will be disagreements from time to time, but we will listen to you. We will actually engage with Sustainalytics to appease your questions, and we do want to do the right thing. So when you bring it all together, I think that we have really the gold standard in ethical compliance. So before we go into Q&A and also my description of Flow Traders, which I think is a good discussion to have, I would like to just quickly summarize the key points I've made today. I started by explaining where we are a core fund. We have 3 aims: make money, avoid losses, minimize volatility. We do this by using our portfolio construction system, which never changes, but then taking action when warranted. This is how we want our money to be managed, which is pretty good because this is where my money is and my extended family's money is as well. So we take it very, very seriously. So thank you very much for your attention.